Hello friends, this is Gayathri Sarun. So in this video, we will have a look about Banking Awareness Part 4, which is a monetary policy, in detailed study of a monetary policy, which is one of the main function of Reserve Bank of India. Okay, so why the monetary policy got introduced by Reserve Bank of India? There is a term called inflation and deflation. Inflation in the economy and deflation in the economy. First, we will have a look about what is inflation. When the money circulation is high in the economy, it is termed as a inflation. And when the money circulation is low in the economy, it is termed as a deflation. Okay, so monetary policy has been introduced to control the inflation as well as deflation in our economy. We can simply call it as cash flow management, and to maintain the price as well as to control the inflation and deflation in our economy, monetary policy has been introduced by Reserve Bank of India. Okay, this monetary policy will be released 2 months once and 6 times in a year. Hence, it is known as bi-monthly monetary policy. Okay, and a committee was created by Reserve Bank of India to control the cash flow management, which is nothing but inflation and deflation. And the committee was created, and the committee was known as Monetary Policy Committee. It consists of 6 members. Based on their report, the monetary policy has been released. Okay, and next we will have a look about tools of monetary policy involved in controlling this inflation as well as deflation in economy as well as the price stability. There will be two tools in monetary policy. First one is quantitative instrument and second one is qualitative instrument. In quantitative instrument, we used to have repo rate, reverse repo rate, bank rate, marginal standing facility ratio, and cash reserve ratio, and SLR, statutory liquidity ratio. Okay, in qualitative instrument, we used to have direct action, RBI guidelines, and moral suasion. Okay, so quantitative instrument we will have a detailed study, but the qualitative instrument I'll explain now itself. Direct action is nothing but RBI is the governing body for all the banks in the country. So whenever the other banks is not following the rules and regulations, the RBI will infuse a direct action or a penalty to the bank so that they will not repeat that mistake again. Okay, which is nothing but direct action in the qualitative instrument. Next one is RBI guidelines. RBI will provide a list of guidelines to all the banks as well as small finance banks, for payment banks, everything. RBI will provide a guideline which need to be followed by all the banks in the country. If it's failed, it will result in a direct action. Okay, then third point is a moral suasion. RBI, as a measure of improving the growth of the other banks, they will request other banks to implement some of the rules and regulations, but it's not a mandatory one. It can be either followed by other banks or not. It's up to the other banks. But the moral suasion is nothing but they'll request, RBI request other banks to implement the certain morals to improve their improve their criterias. Okay, so this is all about the qualitative instrument. Next we will have a detailed study about quantitative instrument. In quantitative instrument, already explained you, inflation is a high liquidity and deflation is a low liquidity. Inflation is nothing but when the money circulation in the economy is high, it is termed as inflation, and when the money circulation in the economy is low, it's termed as a deflation. Okay, first one we will have a look about repo rate. Repo rate is nothing but other banks will borrow money from Reserve Bank of India at a particular rate of interest. Okay, it's for a short term. The short term will start from 0 to 90 days. Okay, for 0 to 90 days, the other banks will borrow money from Reserve Bank of India at a particular rate of interest, and it also termed as a short term loan since the loan was bought for a short term, that is 0 to 90 days. Okay, if RBI wants to control the inflation, they will increase the repo rate. If the RBI want to control the money circulation in the economy, they will increase the repo rate so that the other banks will not borrow money from Reserve Bank of India since the rate of interest is high. Hence, the bank will not won't have a sufficient fund to provide loans to the people. Hence, the money circulation in the economy will be controlled by repo rate. Okay, so if the RBI want to control the inflation, they will increase the repo rate, which in turn result in decrease in inflation. Okay, the current rate for repo rate is 4%. RBI charging 4% rate of interest for the monies which they are lending to other banks. Okay, and I think you people are clear about repo rate. Next, we will have a look about a reverse repo rate. Reverse repo rate is nothing but RBI will borrow money from other banks. It's a reverse of repo rate, so it's termed as reverse repo rate. RBI will borrow money from other banks at a particular rate of interest, and the rate of interest will be fixed by Reserve Bank of India only. This rate of interest will not be fixed by any other banks. This rate of interest will be all the rate of interest will be fixed by Reserve Bank of India only. The current rate is 3.35, and we need to note one more point. Reverse repo rate always it will be less than repo rate, because RBI is getting money from other banks, no, and while giving money to other people, the Reserve Bank of India will have a high rate of interest, while getting a money from other people, it will have a low rate of interest. So reverse repo rate, it will be always less than repo rate. Okay, and reverse repo rate is also known as liquidity adjustment facility, and reverse repo rate as well as repo rate, both are termed as liquidity adjustment facility. And from this, they will calculate LAF coriander, which is nothing but a difference between repo rate as well as reverse repo rate. I think you people are clear with repo rate as well as reverse repo rate. Next, we will have a look about bank rate. This and all the instruments of quantitative monetary policy tools. Okay, and bank rate is nothing but other banks borrow money from RBI at a specific rate of interest for a long period, which ranges from 90 to 180 days. Both repo rate as well as bank rate remains the same, but repo rate, they will give, the RBI will give loan to other banks for a short span of time, which is 0 to 90 days. And for bank rate, the RBI will give money to other banks for a long term, which is 90 to 180 days. Okay, it is also known as long term loan, and the current rate is 4.25%. Okay, and next is marginal standing facility ratio. This is nothing but other bank borrow money from Reserve Bank of India at a specific rate of interest over for overnight period. Okay, this is same as repo rate as well as bank rate. Okay, in repo rate, the other banks will borrow money from Reserve Bank of India for a short span of time, which is 0 to 90 days. And for bank rate, other bank borrow money from Reserve Bank of India at a long term, which is 90 to 180 days. If other banks borrow money from RBI for a specific rate of interest over a night period, for only one night, they will borrow money from Reserve Bank of India at a particular rate of interest. That is called marginal standing facility ratio. And the current rate of interest is 4.25%. Okay. Next, we will have a look about net demand and time liabilities. Before, we will have a look about CRR and SLR. Okay. So first of all, we need to understand one process involved between people and bank. If the people depositing a money in bank, it is termed as a deposit asset for people but liability for a bank, because the bank need to return that money to people whenever there is a demand for people, as well as whenever the people getting a loan from bank, it is a liability for people but it is an asset for bank. We need to return that loan to the bank with interest. Okay, I think hope the concept is clear. Whenever we are people deposit is termed as a asset for people but liability for bank, and whenever the people getting a loan from bank, it is a liability for the people but asset for the bank. Okay, so net demand and time liability is nothing but for the people deposit, we do have four kinds of accounts. First one is savings account, second one is current account, third one is recurring deposit, and fourth one is fixed deposit. So time liabilities is termed as both accounts, like FD as well as RD is termed as time liabilities. Time liabilities, and demand liabilities is nothing but savings account and current account. Okay, so net demand and time liabilities is nothing but people's money in bank in different accounts. Okay, and the as already I said, the savings account as well as current account is mentioned as a demand liabilities, and RD and FD is termed as a time liabilities. Okay, So the ratio between these two is nothing but net demand and time liabilities. Okay. So now we will come to cash reserve ratio. As per RBI policy, particular percentage of money in the bank should be kept in Reserve Bank of India in the form of cash for the future security purpose. Okay. I repeat, as per RBI policy, particular percentage of amount, if I am a bank, I need to keep a particular percentage of amount in Reserve Bank of India as a cash form for my future use. Okay. That cash, what's the percentage means? It's 4% of net demand and time liabilities. Okay. For that only I have explained net demand and time liabilities. Okay. The current rate is 4% of NDTL money, and the minimum it can go up to 3% and maximum it can go up to 20%. Okay. And the RBI will not collect CRR from all the bank. It will have a currency chest branch. For example, I'll explain you this concept with the this pictorial representation. RBI will, this for an example, so it like this only it will work. RBI will keep SBI as a current chest branch, and all other banks will have the respective cash reserve ratio with SBI bank only. Okay. For example, Bank of Baroda, IOB, Canara Bank, everybody will have the 4% of NDTL money with SBI, and SBI will directly deal with RBI, as well as RBI will directly deal with SBI. RBI will not deal with Bank of Baroda, IOB, Canara, because SBI is the currency chest branch for RBI. Okay. So this all branches CRR will be maintained at SBI, and RBI will have a direct dealing with SBI. Okay. Then we will have a look about statutory liquidity ratio. The particular amount of money will be reserved in the bank itself for future use in the form of cash, currency, and security deposits. Okay. I'll tell you the difference between cash reserve ratio and statutory liquidity ratio. In cash reserve ratio, if I am a bank, I need to maintain a particular amount of money in RBI in the form of cash for my future use. But in statutory liquidity ratio, if I am the bank, I need to reserve a particular percentage of amount in my bank itself in the form of either cash or gold and security deposits. Okay. The current ratio is 18%, and for CRR, the current ratio is 4% of net demand time liability. Okay. I think hope the quantitative tools for the instrument for the monetary policy is clear. Okay. The questions will be asked from this topic is injection of liquidity. What is injection of liquidity? Which is nothing but repo rate. And absorption of liquidity is reverse repo rate. And dearer money policy is nothing but RBI increases the loan interest rate due to inflation. I already explained you the concept now while explaining repo rate. Whenever the RBI want to control the inflation in the economy, they will increase the repo rate so that the inflation will be controlled. Cheap money policy is nothing but RBI will decrease the loan interest rate due to deflation. This is reverse of a repo rate, which is nothing but if the RBI want to improve the deflation in the economy, they will decrease the repo rate. The rate which they are offering the loan to other banks. Okay. And the current rate details, I have mentioned the current rate details as of today date, but on 2 months once basis the rate will change. So whenever we are appearing for the exam, please have a look about this rate details. Okay. Then they'll ask if the RR increases, what will happen to inflation? This is reverse of the third question. When the RR increases, the inflation will get reduced because other bank will not get loan from RBI because the repo rate interest will be high. Okay. I hope this video will help you for getting good scores in banking awareness. If you like this video, please do share, subscribe. Thank you.